you could probably risk 20, 30 pips. And what was the upside? We got to, anyway, we bounced 100 pips. So even that little trade, just on the 4-hour chart, you could have risked 30 to make 100. 3-to-1 risk-reward ratio, nice.
Welcome back everyone, we are back with Jason Sen again to discuss some analysis, technical analysis on the charts. It's going to be a follow-up to the interview we've done a few weeks ago, I think, a few days ago. Yeah, so we'll go through the charts, we'll show you how it's trading process step by step. You get to learn a lot about technical analysis, how it's looking at price action, at level, and how to place trades, of course, with all these things in mind. So Jason, good to have you here again. And let's go through it.
Well, look, as I spoke to you last time, 4 main time periods that I follow. I'll start off with the weekly chart, sort of levels and parameters set out in here. Actually, do you know what? I'm going to actually go to the monthly chart. It is important to look at the monthly chart. People forget to do that, but you just don't know what might be on there, especially moving average wise. I mean, look, for example, this is the 100-month moving average. Now, I know that price-wise we're a long way from it, but you see how that 100-month moving average, the blue line, is coming up to meet the fib levels that I've got on here. Now, you know, this is a long way away, so I'm not saying we're going to get there soon. But if we did dip as far as sort of 96.00, 95.00 in the dollar index, you would need to know that this is a really big support level. If you didn't know that, the market might have been trending down for a number of weeks, and you might think, okay, I need to be short because this market's trending lower. Just as you're about to hit an enormous monthly support area in the monthly chart. So this is why we've got to check these longer term levels.
This is a big issue. I see people who look at the daily chart for the levels, and I'm not saying it's a bad thing, but sometimes you could have a resistance on the daily chart, but then it turns out to be a support on like the monthly, and that's a lot more powerful. So
exactly.
That's why you want to check both.
Definitely. So I know I'm crazy enough to go back all the way to the 1980s. Wow. I've put my fib levels on there. You know, they're probably not relevant, but look, let's say the dollar index keeps going up and it gets up to around 106.5. You know, if you didn't have your monthly chart going all the way back to, what is this year? Let's out of interest. That's 1985, that peak for the dollar. Now, if you didn't go back to 1985 and you didn't see that massive peak, you wouldn't know that 106.61 is a huge 38.2% fib that dates back, you know, a couple of decades or more, 4 decades. You know, that's huge. We've got to know that that is a big level, and we're not that far off it. You know, we're 400 pips away. We could get there in the next few weeks. And you would be thinking, right, I want to be long, we're in a bull trend, this is going up and up and up. Maybe we're getting to this peak around the 2000 level, and be completely oblivious to the fact that, and the problem is the banks and the funds and everything else, they would probably have a guy doing their analysis who'd be saying, hey guys, you know, if you're thinking about getting short the dollar, that's where you want to be looking for. That could be a good target. And maybe that is a target for us. Maybe that's where we're going to go. We've been up to, let me see, we've been up to 105, where are we now? 105.00 in the dollar index. When was that? Yeah, that's sorry. We've actually been up to 105.00 last month. So very, very recently, we are really closing in on that 106 area. So anyway, you can see why that is so important. It'll be interesting because probably your viewers will be watching this after this has happened, so they can see whether 106 actually did become a big level for the dollar index. And anyway, looking back on the weekly chart now, even here, it's still important. I'm still going back and years with my analysis and my fib levels, and we've got a big 61.8% fib. This fib level goes back to 2014, so that's 10 years old. It's a big level, and it actually ended up being a huge support level this week. It was the exact low for this week, 101, we'll call it 101.30. The fib level was 101.48. We've got further big fib levels giving a confluence there. This fib level dates back to 2021, so that's over a year old. Anyway, you can see what I've done. I break it all down, and that's given us a huge support level there. So it's not surprising that the market did bounce. And even if all you were doing was looking at fib levels, this shorter term fib level going back to the beginning of this year, or February of this year, 102.68, let's call it, that was a resistance level, and we got to 102.73. So this is why I think fib levels are just so important. I don't think there's any other way that you would have been able to identify those levels if you were not looking at the Fibonacci.
Interesting, yeah, because even if you were to draw trend lines, you couldn't redraw any trend line on this move.
No,
that's good.
It's been such a, I'm not sure if you would call it a parabolic move, but that move from January for the dollar was so strong that, yeah, as you say, trend lines would not really be very helpful.
So what do we do from here? We got the review on the monthly chart. We know kind of what's coming up, but then we're not going to trade this right now. Probably we're going to have to wait and find a better level.
Agreed, because right now we're in the middle of what I think. So I think, just looking at the weekly chart, I think we could now stabilize and probably go into a sideways trend. And as you know, markets don't always just go up or just go down. They like to find a balance. They like to find an area where they can actually create volume, where buyers and sellers can meet. That's the whole purpose of financial markets, isn't it? It's to create volume. Fundamentally, the logic for me is that we're in June. The first 6 months of this year have been chaotic. We're coming out of COVID. Inflation has gone mental across the world. Central banks have lost control of inflation. So these have all been big factors. This is why the dollar's been driven up so much. They're pulling back on QE, major economic events. And of course, then we've also got the war in the Ukraine, Russia unexpectedly. No one really thought that Russia was going to invade the Ukraine. And that's, caused commodity prices to go through the roof. We've got all these huge news events, but I think all that has been digested. It's in the market. What other major news event can give the dollar or some of these other stock markets new direction? I don't think there is anything right now. So I think the market's going to find a period of stability. And also just being that it is summer, markets do tend to calm down a little bit in the summer, don't they? People tend to want to be outdoors more rather than sitting in front of a screen. And people start to go on holiday. Kids break up in 2 or 3 weeks, families start to go on holiday. So I don't know, your big hedge fund managers might be taking the foot off the pedal a little bit. And I think, so these are the reasons that in my brain that we might be entering a period of stability.
Do you look at any candlestick on the monthly chart, or is it only levels that you look at?
Yeah, I will. Bearish engulfing candle, the usual ones, the gravestone dojis and all the ones that we know about. I will keep an eye on these. Even for example here weekly, when the market reversed, we're seeing a series of dojis, four kind of dojis really, indicating that the market is more balanced, and maybe that is a bottoming process. Market got very oversold on the slow stochastic. I don't know whether there was any other level there. I'm not going to go into it in too much detail, but it's a good question. Look at this here. What do you call that? Hammer candle, indicating that buyers. The market's gone down on the weekly chart, but the buyers have come in, they've pushed it up, big green candle follows, and then guess what? Eventually the market takes off, comes for a retest, not quite a double bottom because that's quite significantly higher than the previous low. But again, some fairly neutral candles, not the negative candles that you'd want to see if you thought the market was going to continue lower, and that ended up being the beginning of a big bull run. So I don't know, let's have a look at the monthly chart. Maybe there are some candles on there that we should have paid attention to. Well, there's a bearish engulfing candle right there on the monthly chart that suggested the market was going to fall. So yeah, you're right. We do need to look at the candles on the longer term charts.
So from there you will go and you will look at the weekly chart to see if there's any other levels that you want to look at, right?
I try to remember on a Sunday night when I'm doing my analysis to look at the weekly chart, and so I do keep it up there. I try to remember to look at the monthly chart, but I'll be honest with you, sometimes I forget. But it just shows you that's why it's important. Actually, let's go back to that monthly chart. I think it was the dollar yen. Yeah, it was. I looked over the weekend. So going back to the monthly chart. So again, I'm going to scrunch all this up so we can kind of see some longer term levels. And this is really important. The dollar yen is now testing the 23.6% fib. I've taken it from this peak because the data only goes back up to here. So I've tried to take this. I've assumed that this is the peak of that particular market, and then the market obviously did tumble. So around 130 is a really important Fibonacci level, and we're around that right now. And also, when you look at the monthly chart, the 500-month moving average has only been relevant for the last 12 years because, of course, the data I don't have going back any further. The 500-month moving average is at 129.40. We've broken above there. If we start holding above 129.40, or the dollar yen starts holding above 130.00, this is really quite positive. This is a breakout to the upside that really could propel the currency significantly higher. So, again, monthly chart is almost key to what's going to happen next. You really have to be focused on that right now.
I want to know what you do in the weekly chart. How does that differentiate from the monthly chart? Is it the same thing we look at, or are we looking at different things?
I don't necessarily look at anything different. I will still look at the patterns, the candle formations. I'll still throw my Fibonacci levels on there. Obviously, trend lines are important. I've got a trend line on this weekly chart now, a red trend line, just joining up the big previous peaks. Looks like one from 2008, one from 2015, and that trend line appears to be relevant because it's intersecting right on this 23.6% fib, okay, the market did overshoot on the downside initially, but look at what happened last week. You know, we used that area where the trend line and the Fibonacci meet as a base, and look at look how the price absolutely soared off there. So if you didn't look at the weekly chart, you really wouldn't have a clue as to why the market suddenly turned around and soared back up to the previous high. Probably should break down to the daily chart now. You can see again, the weekly chart, you need to be aware that we're very overbought. And we're very overbought at significant Fibonacci and 500-month moving average levels. Okay, I know the 500-month moving average is at 129.40, but that's only around 100 pips away. On a monthly chart, 100 pips, as you know, is nothing. It's well within a margin of error. You know, we could even go up to 130, 150, and then reverse, and we would have a double top pattern at very important longer term resistance. And as I say, if you weren't looking at the monthly and the weekly chart, you'd have no clue about that. You'd be thinking, we're in a bull trend, I really need to be long this. We're probably going to break above here and soar. But right now, I think I'd rather be short than long, if I'm honest. Daily chart, we're just getting into overbought territory on the slow stochastic as we approach the previous high. So I'm really wondering whether this is a double top. Getting a bit of a red candle already this morning. Maybe that indicates that we have actually peaked and this is a double top at that major longer term. You know, and the nice thing about this is when you look at it longer term, the reaction here, if I'm right, and if this is a double top at the resistance level, this isn't going to be a 50, 60 pip move to the
you have a lot of room to go, yeah.
You know, this could be hundreds and hundreds of pips over the next weeks and months. So this could possibly, we could be right now staring at one of the biggest swing trade opportunities of the year. Interesting for anyone watching this in a couple of months to see what happened.
I'll be curious to hear also if you take a trade that's going to be a long-term trade, like a couple of weeks, how are you going to manage it? Are you going to kind of trail it down and then stop loss over time, or are you going to just leave it and then enter it and then leave it, let it go by itself? Or
I'm not too keen on aggressively trailing stops because too often I've been like that, trailed the stop aggressively, really thinking I'm going to protect this profit. And as you know, the markets don't go move in a straight line. Yeah, small pullback, you're taken out, and then bang, the move happens. So I'm not very aggressive at trailing stops, and also I know some people have a strategy whereby they trail the stop to break even as quickly as possible, and I'm sure it works for them. Fair enough, but for me it doesn't work because why would I be exiting a position right where I wanted to enter it?
Yeah.
So yeah, I would keep my stop above 131.60, let's say, for quite a long time. I'd really want it to be below 127.00 before I started aggressively trailing the stop.
So we have a daily chart now. How are we going to decide if you want to enter a trade on this or not? Are we going to have to wait for a specific candlestick pattern, or is it just based on how we feel about it?
Okay, that's a good question, and I get asked that a lot by followers and subscribers. Do I wait for the candle confirmation? For some people it really works. They need that security or that confirmation that makes them feel safe. For me, I don't trade like that, because by the time you've got the negative candle that tells you that the trade is probably worth putting on, we could be 100 pips, already on side. So right now, I would be quite happy to sell at 130.66, give myself a 100 pip stop, 131.66. I know that we're just surpassing the big resistance levels anyway, so I think it's still a good entry point. I'll risk 100 pips, maybe even 150 pips, give myself a bit of leeway, because I know that I'm going to have probably 300 pips on the table straight off the bat, and that's just to start with. That's just if we hit the first target. So a 2-to-1 risk reward is great, but I know also if we get a negative weekly candle now, let's say we get a bearish engulfing candle on the weekly chart, or something more negative on the weekly chart, new high, a lower close on the weekly chart, that will help to confirm to me that that's a double top. And so I know that once we break below 127.00, we're probably going to 125, we're probably going to 123. We could easily, the first real stop could easily be the 100-day moving average at around 122.00. So yeah, big downside potential if what I'm saying happens.
So if I get this right, the sizing won't change whether we have a negative on the weekly chart or not, but the target will change.
Yeah, good point. Yeah, good point. If we get something more negative on the weekly chart, then that will give me some sort of confirmation that the double top is in place.
So do you look at any kind of intraday time frame as well, like the 4-hour chart, or is that not very useful?
I do indeed. I definitely will. In this situation, the 4-hour chart probably isn't. Well, no, actually, do you know what? It would be, because we start getting negative candles on the 4-hour chart, then I'm going to be a bit more confident that we're going to see something negative on the daily chart. Now, we don't actually have anything particularly negative on the 4-hour chart yet, but a bearish engulfing candle on the 4-hour chart right now I would really be like getting a little bit more excited about this trade idea. So anyway, we don't have it yet, but you can imagine if we have a big green candle now, maybe we spike above, we get up to sort of 130, 150, and then the market collapses and we get a big bearish engulfing candle on the 4-hour chart. I'm going to be a little bit more excited that this trade idea might play out.
Interesting. So what would make a trade trigger versus not trigger here? Would you kind of look at specific placing your entry at a low or something, or would you just try to enter in like take a market order?
I think for me right now a market order would be worthwhile. Maybe not on the whole position. Let's say I wanted to do 4 contracts. Maybe I would do 1 contract now and just wait and see, do I get a negative candle on the 4-hour chart? If I do, then maybe I'll add another contract. Something like that. If I get something more negative on the daily chart, I can add another contract, and maybe on the weekly chart add another contract. So I'm slowly scaling into my full position.
So scaling it instead of scaling out.
Scaling in and scaling out, I really like.
Okay.
I like scaling out because we all have this burning desire to bank a profit. But if you scale out, maybe take off 25 or 50% of the position, you've satisfied that urge, you've banked some profit, and you feel okay. And now you know that if the market returns to the entry point, you can actually get back in again. If the market continues in the direction that you want it to continue in, that's fine, because you still have half the position on and you can still capitalize on that move. So kind of, for me, it's all about mental capital, keeping your head clear, giving yourself options.
I feel like a lot of people will be afraid to do that, to re-enter at their entry point, like to get in back again. Because the fact that if price goes back to the entry means that it's going to go the other direction, perhaps.
It could. Or maybe we'll just retest that. And maybe the market will then reverse again. So yeah, I never know what's going to happen. I'm purely going on.
That's something no one can tell. No one can tell what's going to happen next.
No one has a clue. You're just putting the odds in your favour. And I wouldn't mind risking, if I've managed to bank 200 pips, I wouldn't mind risking 100 of those pips if we retest the level. Because if it works, I know that this is really going to work. This is going to be a big trade for me.
Interesting. So I see a lot of levels here. I'm curious to hear, how do you track what level goes to which chart? Is there monthly levels, daily levels? Is it like all the same, or?
Okay, so good question. Very good question. I will start on the weekly chart. Now I've shown you that already, but just let me show you again. Let me get rid of this box. So ideally, and it takes some time to break these down, but the thing is, once you put the levels on the monthly chart, you're not going to touch them again for a very long time. So it's worth just sitting there, spending 5 minutes, going all the way back, as many decades as you can, break it all down. You saw what I do, so I'm not going to go back to the monthly chart. Now, actually, I am going to go back to the monthly chart, and I'll show you why I do this. This is a little bit of a tip that I do on Fibonacci. I don't know whether you do this yourself, but so I'll go all the way back. There we go. This is my complete roadmap for the dollar yen. Then what I'll try to do is, this hasn't quite worked here, I'll look around the 61.8% fib, and if there's a swing high up there, I'll take that as a secondary set of fibs. Now in this case it hasn't actually worked, but what I will do here is I'll take fib level from here, and I should have done this already, and I will then project that down to the swing low. This gives me another set of Fibonacci levels, and I think they are relevant because this swing high was so close to the 38.2% fib that I think these fib levels are now relevant. Well, I can check if they're relevant. Let's see, how do they tie in? Well, this ties in quite nicely with this little swing high here and here. Okay, there's a little bit of a margin of error we have to accept, but it's worked. I'll take this, and then if the market does pull back, I've now got a secondary support level here. I'll keep doing that, and then I'll break it down into the weekly chart, and I'll keep looking for sub levels. So again, here, this is obviously the start of the big move at the beginning of this year. So I have to put my levels on there, and then I will, again, 61.8% fib. Look how there was all this congestion here. Here, the market, consolidated, and then from here the market took off again. So I'll take another set of fibs here. I'll just keep breaking that down. On the daily chart, I've taken a set of fibs here from March. There was another area. So this is what I had on the weekly chart that I just showed you, and now I'm breaking it down further again on the weekly chart, and again I'll do that on the 4-hour chart. So I'm constantly breaking it down to get these secondary fib levels.
So you don't have any kind of color code or something to know which Fibonacci is from which?
I probably should do that. That's a good suggestion. Thanks for that. I'll color code them so I can see that on the different time frames, because otherwise it's just a mass of these levels. But I've kind of got used to looking at the massive levels now, and I can decipher them. That's actually a really good suggestion for anyone who's going to start doing this.
One thing I'm thinking too is a lot of people, like, let's say, play zones in the market on their charts, but then they kind of fall for this confirmation bias where they have a zone, they want to find all the kind of trade in that zone and see, oh, this zone works well.
Right.
They kind of confirm with the zone that they've decided first instead of looking at the market objectively that time.
Okay.
How do you avoid that?
That's actually a really good point. I think is that called fitting or something, where people they decide on something and they decide.
Confirmation bias.
Yeah.
Like you want to find views according to views of the market.
Right. Yeah, that's it. Well, that's actually something I think I might have said to you in the last interview, where I do my analysis when I have no position on, because then you've got no bias. You're not trying to find something that backs up the position that you've got. You're completely impartial, and you're like, okay, this looks like a good support level, rather than I need to find a good support level because I'm long.
So I'm not sure if one thought I had is maybe you could hide the analysis from like the higher time frame, then only look at this particular market, this time frame, but then that could be confusing as well.
Yeah, you could try that. It's what works for different people and what suits their trading style, what suits their time horizon. If a guy's sitting there scalping the market minute by minute, is different to a guy who's got a job and he can only check the market 3 times a day or something.
So based on what we kind of discussed so far, do you want to maybe take a different pair, different instrument, then we can go through like the whole process again for people to understand better.
Try and do something where I haven't already put a load of fib levels on. I think probably cable is something that I haven't broken down too much. So let's go to the monthly chart. I haven't had a look at this for a while, so this could be quite interesting. I haven't really got any preconceived ideas.
Sure.
Okay, so I'm going to go all the way back. Okay, so I really should take this high, and it's a significant high because you can see that when the price data started here and then we rallied up. Wow, that really just shows you how the pound has collapsed over the years. So take the fib, put it up here, and this is the swing low. What a move. Now I'm going to look at this and say, do I want to keep this on there? And I think I probably do actually, because look how nicely these fib levels, dating all the way back to, where are we now? This goes back to 1972.
Yeah.
So what's that? Is that 50 years? Sorry, is that, yeah, it's 50 years. Okay, and look, the fib levels really did pan out quite nicely. So by the time we'd hit this low, these fib levels were relevant. And look, 61.8% held, 23.5% held. And so these were worth having. Now, I would definitely take a secondary set of fib levels from here. It's around the 61.8, it's very important, and we can go down to the swing low here. And again, look, this 23.6% fib going all the way back to 1972, look how it had an effect there. It really was important. I would then break this down to here. I would take another set of fibs from here. What year is this? Take that down to there. This is 2014. So now I've got more fibs, and look how some of these fibs are really overlapping now. So we're getting areas of confluence. Actually, having said that, this particular level, maybe it is relevant. When we broke above it, this area became good support. And when we broke below it, it became resistance just before the market collapsed. So this is how I would break down the weekly chart. And now and it's nice because I can just leave that. Going forward, wherever we go, I've got my levels, and I can see how they tie in with the moving averages. So for example, if we ever got up to around the 151 area, if we got there over the next few weeks, we would have the 200-month moving average coming in there and showing potential for a very strong resistance level. Okay, moving along, go to the daily. So get my swing high from here. There we go. I don't know why I've got that on there actually. I need to take that off. Oops. Okay, so I actually need to take this one off. Anyway, that's what I would do, and then I start putting trend lines on and everything else. But you can see how that Fibonacci level works so well. 126.45. There was the high. There was the high for the bounce. So for me, Fibonacci levels, you got to use them. They're so simple. They're so quick to put on, and they just give you this big breakdown of it gives you confidence that these little swing lows here are going to be a very strong resistance level. By the time we get there, the 100-day moving average will be lending extra weight to that level.
What do you think these levels work? Is it because everyone uses them, or is it like a self-fulfilling thing? Or?
I have absolutely no idea. It's a really good question. It might be a self-fulfilling prophecy because people like me are doing it all. But I think different people use fibs in different ways. I'm sure other people don't use them in the way I do. So I really don't know why they work so well. Or maybe it's just because financial markets are so mathematically driven. I really don't know. What do you think?
I don't know. I think it's self-fulfilling. I think that's probably the reason why.
Yeah.
Do you look at all the levels, like by default of Fibonacci, or only certain levels that you look at?
Yeah. Okay, no. The 50% is the one that I don't pay much attention to. And maybe I'm wrong, but I don't know. Something in my brain tells me that the 50% doesn't work that well. And the 78.6, I wouldn't put a trade on. I use that more as a target. So I wouldn't sell short, for example, if we got up there. But if we broke above, look, you can see this 61.8%. Let's pretend that we'd got up here. This is obviously going to be a stronger resistance level. We've got the 500-day moving average bang on this level. And if we started breaking above 135.00, I would say, well, we're going to go to probably some of these peaks that we've got here. Ultimately, we could get to the 78.6% fib if all the conditions are right. But I'm not sure if I'd be selling it there. Although we have got price action confirming that is going to be a stronger resistance level around the 137.5 area. So who knows? Maybe we'll get a negative candle when we get up there, and I would decide to put a short position on. You don't really know until you get there. Do you know what I mean?
Yeah. What would we be looking at here in terms of trading? Will we want to place a trade here or not at all in this kind of market?
For me right now, on the daily chart, it's not telling me anything. We're kind of in no man's land. We're halfway between these points. Yeah. So I would have to go down to the 4-hour chart to look for a real opportunity. We're in a bear trend. We've stalled at the first 23.6% fib. So I've got a negative bias in my brain. So I'd rather be short than long for that reason. I can even put fib retracements on here. Look, this little bounce we've got. That turned out to be a really good support level, didn't it? Just on the 4-hour chart, the 38.2% fib worked with the 100 period moving average on the 4-hour chart, and that alone would have been a really nice trade. You could probably risk 20-30 pips, and what was the upside? We got to, anyway, we bounced 100 pips. So even that little trade, just on the 4-hour chart, you could have risked 30 to make 100. 3-to-1 risk-reward ratio, nice.
A long within a short context, no?
Yeah, exactly.
Okay. You still want to take those trades that are against the bigger trend?
Sure, why not? Why not? If you're there and you're eating your breakfast and it's early in the day and you see that happens and you think, hey, I can probably, even if your target was 125.40, I can risk 30 pips to make 70 pips. Why not?
And that's because we're between two zones. You wouldn't do this if it's like a resistance in a bigger time frame.
I would rather look at a resistance level. Is that what you're saying? Yeah, because I'd rather be in a short trade, bearing in mind the longer term trend. But it's not so important if you're just trying to do a trade for a couple of hours. In the short term, we are in a bull. This is in a 2-week bull trend. So if I'm just looking to scalp it for 50, 60, 70 pips, I don't mind going long.
Interesting. So I know people are going to ask, the moving average used, are they all the same period on every time frame?
Yeah, so I actually use quite long-term Fibonacci moving average levels, and the reason is because I was providing analysis back in the day for the banks. They weren't interested in 30 pip, 40 pip levels. They want to know the bigger levels. So whilst I would happily agree for people to be using the 20-day or the 25-day moving average, I don't actually use it. I start with the 50, and I don't even pay that much attention to the 50. Although, look, the black line here is the 50, and it has been quite a good indicator of support and resistance levels. So actually, on the 4-hour chart, this black line would have been worth paying attention to if it coincided with other Fibonacci levels or trend lines or whatever. 50, 100, 200, 500. Those are the moving averages that I use across all my time periods.
Interesting.
And I think they work well as support and resistance levels. I look for the moving average crossovers and all the other things you're supposed to do with moving averages.
Now, why would a bank pay for these services? Because it seems pretty simple to do on a high level like this when you're sharing it. It doesn't seem like something like that you need like a long experience with, or yeah, you need experience for sure with it to be able to do the right levels. But it seems pretty simple for anyone who's an analyst that could work for a bank and do this. Why would they pay someone like you to do it?
That's a really good question. Okay, so the tools that I use are very simple, but I think you have to have the experience of putting it all together. It's like, okay, I'll use an analogy. When you drive a car, when you're learning to drive a car, and when you get to the destination, you don't think, wow, I did all those processes to get to that destination. It's automatic, and I think, obviously, when you're experienced at anything, and that is important for technical analysis as well, you look at things and there's just something in your brain, I guess, that says to you, that you subconsciously says to yourself, I've seen this set up before, I've seen the market do something like this before, and you just get more confidence as the years go by, and you just think, nah, this is worth a try. I almost don't know sometimes why I feel strongly about something, but basically what I do is very simple, and people can learn it pretty quickly.
That was a really good run through of how you trade, your process, and how you analyze the market too. I think that was really useful for people. If you guys want to know more, you want to see more of that stuff, Jason has a YouTube channel. He's doing a lot of videos there on his channel, so you can give him a follow there. That would be pretty cool for you to check out his stuff. And you're doing videos like every week on different markets, and you're sharing like how you look at the market, which is very nice. So people can benefit a lot from that. They can also check out your website for more information. You want to give them a bit of place where they can follow you?
Yeah, so YouTube channel is Day Trade Ideas. My website is daytradeideas.co.uk, but basically Google my name, Jason. My surname is Sen, S-E-N. You'll pretty much find me on social media channels.
Awesome. But definitely give him a follow to begin with on YouTube, and that'll be a good way for you to learn more stuff that he's doing. Really someone that I admire for his process and his dedication to trading. And Jason, thank you a lot for sharing these tips, and we will catch you guys back here pretty soon. Ciao.